Government now confirms that the rising interest rates within the local market have pushed it into external borrowing, but within the budget framework.
Parliament approved 4 trillion shillings to be borrowed from domestic market. Now, as we started implementing the budget, there was a faster depreciation of the dollar, but also the interest rates went up. So it's now become very expensive for government to borrow from a domestic market at higher interest rates. So we are looking for a loan that is cheaper to replace the money that we are not going to borrow from the domestic market as approved by Parliament. Therefore, that's a loan which we have looked for.
There has been widespread concern from the business community and civil society on a very weak shilling, whose ripple effects has seen lending rates continue to soar.
Which were based on a different cash flow, and you start charging them new interest rates, which is so huge, and they will not afford, and that will result into a lot of default.
When you look at the domestic borrowing, one key thing that stands out is that when government borrows through the domestic banking system, it creates competition for those funds, and hence upward pressure on interest rates.
However, experts also raise caution, albeit with the economic sense for government on opting to borrow externally so as to save Bank of Uganda the burden of depleting its reserves.
You run a risk of servicing your foreign liabilities, or what I would term as considerably expensive way of financing this or paying back this sort of FX liability.
The Uganda shilling has depreciated against major currencies such as the dollar by more than 20% since the start of the year, even with over 200 million in sterilization efforts by the central bank. Ingrid Nantege, NTV.